Well, today on Smart Money, we're talking about how to plan your finances if you are a millennial. That's in the age group of 26 to 41. And Prableen Bajpai of FinFix Research has been speaking to us. Prableen, before the break, you were telling us that planning your goals is fine, but you need to keep in mind inflation, right? So your money is not going to be worth the same 20 years from now, given the kind of inflation situation that India is in. So tell us exactly, give us the numbers. How do I manage my expenses today, given the inflation situation?
Right. So inflation hits on multiple counts, Sonia. The first one being, let's say, the cost of living. So at 33, if your cost of living is 75 and you want to retire at 55, your cost of living, your monthly expenses would be 2.7 lakhs. And by the time you're 83, this would be almost close to 12 lakhs a month.
Wow.
So typically, it is doubling of your expenses every 12 years if we go by a general rule of thumb. That means that is so crucial to factor in inflation while planning for your future goals. Okay. Second is the impact on real return. Because this is where a lot of us just look at returns superficially without looking at the real returns. So a fixed income product today giving me 6%, and inflation being at 6% means that my real returns, Sonia, are zero. And if I add taxation to it, I'm actually, in negative. So there is depletion of purchasing power. So in nominal terms, there is no change. But in terms of my spending power, there is going to be depletion.
Okay, just one question there. Just one question. First of all, I don't know any 30-year-old who's thinking about what they're going to be doing at 80, at the age of 80. But I take your point. I mean, folks, if you are in your 30s, if you feel like, oh, my expenses are 70,000 per month now, when you turn 70, it's going to be much, much more. So get planning with your finances right now. My question to you is this, that, you want to, of course, keep inflation in mind. But what about some of your, you have large goals, right? I mean, if you want to buy a house, say in the age of this 30 to 40 period, a lot of people want to purchase their own home. If you invest all of your money in equities, then that goal may remain unfulfilled. So how do you sort of plan that?
Right. So, Sonia, let's go, at a broader overview. So going by a thumb rule, put not more than 40% of your money as EMI. So if you're looking to buy a house, it's good. Let's say 3 years down the line, you want to make a down payment. You can start saving something on a monthly basis, maybe a SIP into a debt fund. And that can help you with your down payment and keep your EMI within that limit. And of course, reduce your other, unproductive sort of EMIs, let's say your personal loans or your car loan, which do not even give a tax benefit. Then comes your investments. So investments, one, we know that today what is the requirement, and then we factor it, we add inflation to it, we get a future value, Sonia. And that is where, we start mapping that, okay, my EPF and my, let's say, 20,000 per month SIP is for my retirement, for a specific goal. You may have some medium-term goals. Let's say your child will be going to college after, let's say, 12 years or 10 years. That can be something, again, you have to look at what is the expense today, and then you start saving for it by factoring in inflation. So there will be a use of different instruments. It'll be PPF, EPF, as well as mutual funds together. It cannot be in equities totally, because we also have to maintain our asset allocation. There has to be a kitty for your emergency also. There has to be something in fixed income. And that is how, you create a robust portfolio, because finally, how you reach your goals is actually more dependent on how well diversified you are across different asset classes.
Okay, all right, got that. How does inflation impact planning for your retirement? I mean, what kind of steps do you need to take there?
Like I said, till your retirement, you have to see that what will be your monthly expenses. And then you look at the corpus. And here, Sonia, two very important factors when you're looking at your retirement is that, we usually think that, okay, even during my retirement years, maybe, I'll be getting a 8% sort of a return. It's a very usual assumption that I see. No, you're not going to get that. Even today, if we say that we put everything in, one of the best government schemes, which is going to give us 7.5%, it's very important to look at taxation during your retirement, because with the kind of corpus, monthly corpus that you would require, a lot of people will actually land up in a very high tax slab, 20 years from now. So keeping return expectations during your retirement years is very crucial. And then what is the age that you're looking at, for your retirement? Let's say if you retire at 55, are you going to cater till about 85 years of age or 90 years of age? So within retirement, of course, we factor in inflation, but also what are the expected returns from your retirement corpus that you're looking at and the longevity of life? Those to become very crucial. And of course, this is one of the goals which is best, I think, catered to through your EPF and SIPs and mutual funds.
Okay, well, most millennials I know want to retire at 40, forget about 50 and 60, right? And Gen Z, let's not even get there. They're not even talking about working. But I have a very helpful table here, so I just want to get that up on board about the retirement corpus that you need. So just explain this to us, right? If your current age is somewhere around 30 to 35 and you're looking at a retirement age of 55, your inflation rate taking 6%, your monthly expenses will be about 3 lakhs at the time of retirement. So you're saying a targeted corpus is somewhere around 7 to 13 crores is what you need. Just explain this to us. So how much do you need to spend or rather invest per month in order to attain that corpus?
Right. So the requirement here is dependent on why it varies, Sonia, because the monthly expenses are similar, about 3 lakhs at that time. But the target corpus is different because in one scenario, we've taken about 5% returns from the retirement corpus. Because by retirement, a lot of people are not wanting to invest in equities, though they should, but they're really looking at capital preservation. So we are taking a very conservative figure here. If we see that, they can get about 8% returns, the requirement of the corpus, which needs to be built, actually goes down to about 7.5 crores. And then finally, if we are looking at that, instead of 85 years, we are looking to cater to 90 years of age with a 5% return only during retirement, then the requirement further goes up to about 13.5 crores. And here, Sonia, the kind of the requirement would depend on which option is picked by them. So it can vary from, let's say, 30,000 a month to 40,000 a month, and further, depending on which option is picked by them to cater to this corpus, to build this corpus.
Okay, I know this topic that we're going to discuss next is something that you can discuss for over an hour or more. But just to briefly summarize for paucity of time, where do you include your health cover or your life cover into all of this? At what point do you buy term insurance? I do know that if you have dependents in your family, you need term cover for sure. But just an overview, for a 30-year-old, what's the best thing to do?
So I think if you're unmarried, but you have parents who are dependent on you, then you definitely require a term cover. Your requirement for a term cover, Sonia, increases if you're married and if you have kids. And you must revisit your term cover, let's say every 5 years, because probably the first time you got it, you had one kid, and maybe 5 years later, you have another kid. So that's very crucial. And the term cover must be increased if you have a huge EMI on you. Let's say you have one CR worth of home loan on you. You must increase your term cover in that case. Health cover, in addition to, I think, whatever is provided by your employer is a good thing, because you may want to take a career break, or there may be some other, situation where the cover may not be sufficient. So while you're healthy and young, I think cater to a health cover as well, which covers your parents. And I think thirdly, something which is very important is your contingency fund, which has to be, as a general scenario, has to be about 12 times of your EMIs, monthly expenses, your premiums, your investments, everything together. And of course, if you are in a, let's say you're running your own business, you're an entrepreneur, the requirement would go up. If you're a double earning income couple, the requirement can be slightly lesser. So this would depend on case-to-case basis, but I think these are, some of the non-negotiables while you start planning your future.
Okay, this was a very, broad brush overview, but very, very helpful one, Prableen. Thanks a lot for joining in and explaining to our viewers how they should go forward with achieving their life goals and what's the kind of financial planning that you need to do in your early 30s and 30s to 40s. Thanks a lot, Prableen, for joining in.
Thank you.
Well, with that, it is curtains down on smart money. But before that, we're going to tell you our financial tip of the week. Every week, we come out with some financial tools that can help you in your journey. And today, we talk about 5 important things to remember before you invest in index funds, in passive funds. First, you need to find out the expense ratio. Now, expense ratio is the fees that is charged by the investment company to manage the funds of investors. A reasonable expense ratio for an actively managed portfolio is about half to 7.75%. And for passive funds or index funds, the typical ratio is about 0.2%, but it can be as low as 0.02% or less in some cases, and hence the attractiveness towards investing in index funds. The second thing, find out the tracking error. Now, tracking error in simple terms is how much the fund's performance has deviated from those of the index. Ideally, the return of such funds should match those of the underlying index, but due to expenses and cash equivalent, it may be lower. Obviously, the lower the tracking error, the better it is for you. Third, find out the AUM of the fund. Larger the AUM, more stable the scheme is and better to invest in. Now, the AUM of funds are easily available in all fund fact sheets on the AMFI website, on Money Control, Value Research, etc., on the company's website as well. Fourth is taxation. Taxation of index funds. Being equity funds, index funds are subject to capital gains tax. On redeeming the units of an index fund, you can earn capital gains which are taxable. It's the capital gains earned by you for a holding period of up to 1 year is short-term capital gains, which is 15%, and capital gains of over 1 year is 10%. And the last and final, most index funds have an ETF option. And for those wanting to buy in demat form or are keen on intraday trading and prices, you can look at investing via the ETF mode. Now, index funds have a higher expense ratio as compared to ETFs, but ETFs also have a transaction cost which is attached both at the time of buying and selling. All the best with your investments. With that, it's a wrap on this edition of Smart Money. Thanks for watching.